This conference will now be recorded.
Okay, good morning everybody, and thank you for joining us this morning for this Budget 2021 update. It's going to be hosted by myself, but it's going to be given by Chris Bentley, who's our tax director, and Alison Ward, who is our tax manager. So they're going to enlighten you on all the changes that have happened over the last week or so. We've deliberately held back on giving this because we wanted to wait and see what all the detail that comes out, which normally filters out over a few days since the original budget actually happens. This session is being recorded and will appear on our YouTube channel later on today. So if there's anything you want to catch up on or feel that you've missed, please feel free just to go to YouTube, search for Harts Limited with limited spelt in full, and you'll be able to see a copy of this webinar along with the slides, and then along with all the other webinars that we've been doing since about this time last year, on average about 2 a month. And we've got some few exciting ones coming up as well, and some new videos coming up in the next few months as well, so watch out for those. Be delighted if you would just subscribe to our YouTube channel. So if you could do that, it means that you don't need to be notified by us every time there's a new one there. You'll be automatically notified by YouTube, which is a better way to actually do it. Make use of the chat box. You've seen a speech bubble in the top right hand corner of your screen. Please feel free to put in any questions in there. Or if you're feeling brave, unmute yourself in front of everybody else and you can start to ask some questions. We're quite happily to make these sessions as interactive as possible because we want to get as many questions in as possible. What I'd also just like to, before we get started, remind you of is that we have our ebook, which is available, and to be able to download as a freebie. So if you go to our website, which is here, you'll see this on our front page of our website. If you just scroll down and have a look at, take a fresh look at your business and get our free ebook on strategic planning, just stick in your email address and you'll be able to get a free copy downloaded to you. Okay, I'm going to stop sharing that and go back to sharing what we were doing originally. And what I'd like to do is just get everybody's views. We've got quite a few people on this call, and if you could just give me an answer as yes or no into the chat box. Was the budget, in your opinion, good for business? Could you give us a yes, or if you think it was good for business, or a no if you don't think it was? And then we can have a straw poll of what we think people have thought of the business so far. So if you could just stick your answers into the chat box, that will be great. So yes if you think it was good for business, no if you don't think it was. We've got a few replies so far, and at the moment we've got a resounding yes, mostly. Yeah, the replies are still coming in. Please feel free just to stick in yes or no, and we can get a general idea. Yes in the short term, yes but not mine. We've had one no so far, so we've had quite a few replies already, and a lot of the answers to this are yes. So I think it's a general thumbs up for Rishi this time around, but let's see what else he's got planned when we have these consultation documents coming out later on. So that's enough from me for now. I'm going to hand you over to Chris Bentley, who's going to take you through all the budget and what it means for you.
Okay, thank you, Stephen. You just flip the next slide, please. I was going to say we have to start with the inevitable disclaimer that this webinar is for general guidance only, and we should be consulted if you're going to undertake any action based upon it, so that we can ensure that it is tailored, our advice, to your specific circumstances. I would stress that this time in particular, as a lot of the detail of the budget is still to come out. As Stephen has said, we've deliberately held back for a few days in the hope that some of the detail would come out, and that has proved the case. Holding back also gives a bit more chance to reflect on it and think of some of the things that people might look to do as a consequence of the budget changes, rather than jumping to be the first out with the information. But unfortunately, we are still waiting quite a lot more detail, and the expectation is that a lot of legislation will be, or draft legislation will be published towards the end of this week. Thursday is the day that seems to have been bandied around, but it can and does vary from year to year. So if we move on to the presentation itself, we'll start with what I would consider to be the key themes in the budget. Now, over the last 12 months, I think it would be fair to say the country and the economy has had one single priority, which has been driving down virus cases, almost to the expense, the ignorance of almost everything else. Now, hopefully the vaccine programme is meaning that they're able to move away from this and start looking at some of the collateral damage that's been caused by the actions of the last 12 months. One of which, of course, is the job of repairing the public finances. The expectation for this year's budget deficit is somewhere between £300 and £400 billion. I think next year they're still expecting of the order of £200 billion. To put those numbers in some kind of context, after the financial crisis, I think it peaked at about £150 billion. So we're talking of the order of 2 or 3 times greater in terms of the amount of damage that has occurred to the public finances and will at some point have to be repaired. That said, the government's view isn't yet that we're yet at the point where they can actively repair the public finances. There are still a few more weeks, if not months, if not years, of supporting businesses before the job of repairing the public finances can really be undertaken. And on top of that, the government is also aware that there are the challenges brought about by Brexit, the dislocation, but also the opportunities, and how do we rebuild the economy, both for that and also for the longer term structural changes, remote working, internet sales, etc., that are working their way through the economy. So the 3 bullet points there at the top are the government's 3 key priorities with the budget. And as you think through those and through the measures that's been announced, it seems very much designed to encourage spending and investment in the short term by business, but also by individuals, by pumping lots of money into the economy over the next 6 months, to a lesser degree over the next 12 and 24 months, but then with a period of significant and sustained tax rises to follow. So I might even characterise the budget as buy now, pay later, or while we're on the retail theme, perhaps deals finish 2023. As certainly for businesses, there's a very benign environment over the next 2 years, followed by a much tougher environment from April 23. Alongside that, although on one level the budget is quite quiet, there's continuation of existing business support, a few tweaks to business support. The next 2 years sees measures in the corporate sphere, but not particularly in the individual sphere. We are expecting a number of significant consultations to be announced on the 23rd of March. They will include capital gains tax, inheritance tax, we're led to believe, potentially pensions tax reform. Are there any others? Can you think of, Alison?
Not off the top of my head.
No, I think there are other ones that are likely to come out. So the expectation is we could see some fairly significant changes in the tax system in April 22 or possibly April 23 off the back of these consultations. The consultations will likely give an idea of where the government wants to take tax policy in those areas. But the reason they're out for consultation is because they're in the difficult category. Actually making it work is far more difficult for the government than actually setting out an idea of the way they want to travel. They need people to point out the pitfalls and things like that. So plenty more to watch out for, but for the moment, an awful lot of it is business as usual in terms of the broader tax environment. So at this point, I'm going to hand over to Alison, who is going to carry on to present our first section on business support.
Hi, good morning, everyone. So if we could just move to the next slide. So the first thing we're going to talk about is the furlough scheme, which was due to end on the 30th of April, but has now been extended until the 30th of September this year. And there's going to be a phased reduction in that scheme in order to prevent a cliff edge, which could cause some widespread redundancies otherwise. So for May and June, the furlough grants will continue to be 80% of your employee's usual pay for the hours not worked. But then in July, we're going to start with the reduction. It's going to be limited to 70%, and the employer is going to be required to contribute the remaining 10% to keep the employee's wages at 80% of pay. And then August and September, we're going down again to 60% provided by the grant, and the employer contributing the extra 20%. And throughout this, employers will continue to be responsible for paying the employer's NIC and the pension contributions on the full amount that is being paid to the employee, so the 80%. So if we move to the next slide. So that was our support for employees, and now we're looking at our support for the self-employed. So the budget provided us with confirmation on how the fourth grant, which was always in the pipeline, how that is going to be calculated. So as previously, it is going to be 80% of the 3 months average trading profit, with that cap at £2,500 per month. And the fourth grant is going to cover the period February through to the end of April, and it can be claimed from late April. That is when the claim period is expected to open. And it should be actually claimed before the 31st of May. The welcome news from the budget also was that the scheme has now been extended to those who are newly self-employed. So there was a lot of outcry that people who were newly self-employed missed out on the earlier grants. And the government has listened to that, and what they've said now is that for people who became newly self-employed in the 2019-20 tax year, they can now take part in claiming this fourth grant, provided that they have submitted their 19-20 tax return by the 2nd of March. So last week was the deadline for doing that. And this move has been estimated to introduce a further 600,000 traders into the eligibility for this grant. Now, yesterday, HMRC did make an announcement that they are beginning to contact the newly self-employed who may now be eligible for this scheme in order to verify their details, so that they've got the right details on the system, so that when the claim period does open, it can be accessed as soon as possible. So they've mentioned that they'll be writing, and that they'll also be calling customers, as they like to call them, if they've got their telephone number on the system. But people who haven't received any contacts should still be waiting to receive their personal claim date by mid-April. Obviously, if you haven't heard anything by then they are suggesting that you go onto the website and look at the section for self-employed income support scheme and make contact that way. But that is saying please wait till mid-April. And then there is going to be a fifth grant, which will cover the 5 months to the 30th of September. But we are being told now that it's going to be calculated on a different basis. So it's going to be linked to a reduction in your business turnover. So if your turnover has fallen by 30% or more, then you will continue to receive the 80% of the 3 months average trading profit, with that same cap of £2,500 per month. But if your turnover has fallen by less than 30%, the grant is only going to be 30% of your 3 months average trading profit. And the cap on that is going to be £950 per month. So these are the limited details that we know to date. We put the point that the eligibility criteria may change, because we do expect further details on this fifth grant to be issued to us in due course. So at this point, I'm actually going to pass back to Chris, and he's going to talk you through what's being done to help the hospitality sector.
Yes, thank you, Alison. So moving on to the government support packages for particular sectors that have been affected by the last 12 months rules. The ones that spring to mind to most people are retail in the high street and the hospitality industry. Travel is the other one that's been massively affected, but then there doesn't seem to be much for the travel industry at all. Returning to where the government is providing support, high street and hospitality, the big news is that those pubs, restaurants, hotels, gyms, hairdressers, they're all eligible for, they're terming it a restart grant for up to £18,000, depending on their rateable value. Retailers who've been forced to close are eligible for smaller grants of up to £6,000. Don't know if that's to do with the fact that the government thinks that the first category have suffered more, whether or what, but there is that difference, or possibly because the pubs and restaurants are going to be closed, certainly indoors, for longer. My suspicion is that everyone will be outside come the middle of April. On top of that, there will be significantly increased business rates relief again this year for businesses in those sectors. Businesses in those sectors will receive full relief for their business rates for the first quarter of the 21-22 financial year, and then will receive 2/3 relief for the remaining 9 months. That effectively means that if you're in those sectors, you'll get 75% off your business rates for the next financial year, 21-22. It's expected that the grants will again be administered by the local authorities in the same way that they have been so far through the pandemic, and eligibility for these grants will be based on the businesses which were required to close in England on the 5th of January. Our understanding is that anyone who's in Scotland, Wales and Northern Ireland, that the local devolved administrations will be making similar arrangements of their own choosing. So if we move on to the next slide, which is again focused on the hospitality sector. The government last summer announced a 5% VAT rate for most eat-in hospitality, with the exception of alcoholic drinks, that was originally going to last until January of this year. Obviously, things have changed. In the autumn, they extended it till the 31st of March. The hospitality sector is still shut, and so they've now extended it till the 30th of September, with the intention that the VAT for food, non-alcoholic drinks from restaurants, pubs, cafes, etc., as well as holiday accommodation admission to visitor attractions, will increase to 12.5% from the 1st of October this year, and that rate will run through till the 31st of March next year, before the standard rate of VAT finally returns on the 1st of April next year. I suspect that will give quite a lot of people fun with reprogramming their tills and things like that, and businesses that take deposits in the accommodation sector will have particular complexities around their VAT accounting, which we can go into with anyone who is affected by those changes. And then on the next slide, Stephen, we've got a few details on a new recovery loan scheme which the government has announced. It will be available from the 6th of April this year and is open to all businesses, including those who've had a Sybil's loan or a bounce back loan. The idea, I think, behind the government's policy here is to lend even more money to those businesses which might be short on cash flow at the moment but have underlying good businesses, to enable them to invest, make the necessary changes to get properly up and running again. The way the recovery loan scheme will work is very similar to the current Sybil's loans, in that the loans will be made by ordinary commercial lenders, but they will be supported by an 80% government guarantee. Idea being that they go to businesses which are genuine, reasonable risks to lend to, but the level of risk which the bank takes on is much, much lower. i.e. there shouldn't be barriers to banks handing them out because a bank is only taking a small fraction of the risk, but it's not a blank cheque. And the reason I mention the blank cheque is because the government, tucked away, has also announced a task force to ensure that coronavirus support measures are being used appropriately. Now, we all know that they're investigating furlough claims to quite a high level of detail. We've dealt with a number of furlough audits ourselves, but they've also mentioned within that bounce back loans. And I think that's deliberate. At the same time as announcing the recovery loan scheme, they are conscious that a fair few bounce back loans in particular have gone on extensions, new cars, and various other things that they perhaps weren't intended to go on. So I just mentioned that around the recovery loan scheme, that they are looking at it more closely than they have done with bounce back loans. And that concludes the section on the government's business support measures. And then we'll come on to the second section of today's webinar, which is all about changes to the tax system. The headline tax change from the budget is the corporation tax increase. It's significant in that the headline rate goes up from 19% in one fell swoop to 25% on the 1st of April 2023. For accounting periods that straddle that date, the usual practice is that the portion that you split the accounting period in two. Let's say it's a calendar year 2023, the first 3 months would be taxed at 19%, so a quarter of the profits would be taxed at 19%, and then the last 9 months, so the remaining 3 quarters would be taxed at 25%. However, they do like to make things complicated, and also they don't want this to hit small business any more than it has to. Though in practice, we suspect that most small businesses will be hit by this due to some of the other rules that will inevitably go around it. So the headline is that the 19% rate will remain if your profits are less than 50,000 in a company, and that there will be a tapered rate between 50,000 and 250,000. If we do the maths for that tapered bit, the expectation is we will end up with an effective rate of 26.5% on profits between 19 and 250,000. And that's necessary to take a 19% rate on £50,000 profits up to a 25% tax rate on £250,000 of profits. Now, some of the details we're still waiting for to be confirmed are what anti-avoidance rules there might be around that. I think the expectation is that there will be similar rules to the old associated companies rules, which for those of you who've either been in business or been in practice for more than about 5 years will remember there used to be a higher rate of corporation tax for large companies and a much lower rate for companies who made profits, and I think it was 300,000 was the old limit. But the 1.5 million top limit and the old 300,000 bottom limit were split between related party companies. The idea being to avoid someone breaking their business into 2 or 3 to reduce the amount of corporation tax that is payable by the business as a whole. So although it's not been confirmed, the expectation would be that there will be similar rules brought back in again. And that's part of the reason why I expect that a lot of smaller businesses will be hit, at least in the tapered bit, even if they're not on 25% on all of their profits. There is also a suggestion that the headline rate of 25% will apply to family investment companies and any other non-trading entities, investment entities, which have profits below 250,000, which again is echoing the old rules that applied before 2015 with the concept of close investment holding companies. Again, we'll see more detail spill out over the coming days. Now, what does that mean in practice? I'm actually going to jump straight to the bottom bullet point, that bringing forward profits might be an idea. We all have, a lot of businesses have scope for recognising profits slightly earlier or slightly later in certain circumstances, quite legitimately. Now, I think this could be a case where you might want to deliberately time things so that your profits are higher in 21 and 22 and lower in 23, because that will reduce the amount of tax you have to pay. Pension contributions are an obvious one. Investment decisions will also need to be considered, as we'll come on to afterwards. But the other thing that the rate change will alter is whether business owners should automatically be taking dividends. In most cases, we think that business owners will still want to take dividends. However, it is based on the rates we've now got, we can see a case where if someone who is a sole business owner and there's no opportunity to send income to a non-working or lower earning spouse, so no opportunity for income splitting, and that individual is spending all of the money that they draw out, it might actually be better for that individual to go on PAYE by 2023. That sounds completely counterintuitive to what we've seen over the last few years, but with 25% tax rate and higher rate tax on dividends, it is actually going to be cheaper, even with employers' nick, for some individuals to go PAYE. So those are conversations that we'll need to have a think about over the next 2 years, so that arrangements can be put in place with effect from April 2023. For the moment though, the rate remains 19%, so there's no need to do anything. And it will also remain the case even after 2023 that for many people, dividends will be the better option. So if I then go over onto the next page. And some of the further tax changes. Now, if you're suddenly thinking, oh, hang on, I'm going to be paying more tax than my employees despite taking the risk, this isn't a good role, this isn't a good budget for business. The next slide will perhaps shift your thinking back towards what you originally said of this being a good budget for business. Now, the first big change that we've got is the super deduction, which has been trailed in the press quite a lot over the last week or so. The idea is to encourage businesses to invest in new capital equipment. So that is any plant, machinery, other equipment that you need to use in your business, other than stock. And there is also an exclusion for cars. There are also exclusions for buildings themselves, because buildings come under a different regime. But for anything else, vans, machines, even office equipment, there will be this super deduction which applies from the 1st of April this year for 2 years. And the 130% deduction is more generous than the current annual investment allowance. At the moment, if you buy, I'm going to take an example of a new van costing £25,000. No, I'm not. I'm going to make it £20,000 because the maths is easy. So that van at the moment you buy for £20,000, you get to write off the full cost of £20,000 against the company's taxable profits. From the 1st of April this year, you won't write off £20,000, you'll write off £26,000 against the company's taxable profits, 130% of the cost of that asset. And that is unlimited in terms of the amount of spend that you can put through. So we do have businesses that occasionally are constrained by the 1 million limit on the annual investment allowance. They don't need to worry about that. So for a lot of businesses, it may well be worth putting back some spending that you were thinking of doing before the 31st of March and instead doing it in April. There's also, for those who have been affected by losses in the last 12 months or who are likely to make losses in the next 12 months, there's an extension to the usual rules for both sole traders and companies in terms of how far they can carry back their tax losses. Usually, if a company or a sole trader makes a loss, it can be carried back only 1 year, 12 months. However, for losses that were made in accounting periods ending between April 2020 and March 2022, we can carry those back for 3 years. And that would enable those businesses to obtain a refund of corporation tax already paid. Now, we're conscious that there will be some businesses who may well have already filed their corporation tax returns, perhaps in April, May or June 2020 year end. We can go back and revisit those and potentially carry the losses back further. We have until 2 years from the end of the accounting period to do so. So if you are in that position where you've already submitted a loss-making tax return for a period ending after April 2020, don't worry, it's not lost. We can go back and revisit. So at this point, I'm going to hand back over to Alison, who is going to cover the personal tax and further tax changes that were made in the budget.
In the meantime, if anyone's got any questions or anything they want to ask, please feel free to stick it into the chat box, or if you want, just jump in, unmute yourself and ask a question. We'll have plenty of time for questions at the end as well, so feel free to do so, but make use of the chat box if you want. Thank you.
Just a couple of points to pick up from the earlier sessions just before I get going. On the self-employed income support scheme, I just wanted to mention that this is taxable income and it is also subject to the class 4 self-employed national insurance. So the grants that you are receiving do need to be disclosed on self-assessment tax returns. They are taxable according to when they are received. So any grants that have been received up to the 5th of April 21 will need to go on a 2021 self-assessment tax return, and any grants received post will go on the tax return for the year it's been received. So just a reminder that when you're getting all your information together for your accountant to complete your tax returns, that you need to include the grants that you've received and the dates that you've received them. So just on that point, just on the previous slide that Chris was talking about, just to confirm, the losses part applies to companies and sole trader businesses or partnership businesses, LLPs, but the super deduction is only available if your business is a limited company. Just wanted to make that clarification point there. Okay, so moving on to income tax. So the personal allowance increased to 12,570. This is an inflationary increase from April this year. And the higher rate threshold was also increased, inflationary rise, to £50,270. And then both the personal allowance and the higher rate threshold will be frozen until the tax year 2025-26. So this has the potential to bring in another £19 billion just through fiscal drag alone. The tax rates, there's been no changes to those. Basic rate remains 20%, higher rate 40%, and the additional rate 45% for any income over 150,000. Now, there were some rumours before the budget that there might be changes to the dividend tax rates, but these remain as they were at 7.5%, 32.5%, and 38.1%, depending on where that income falls to be taxed and in which tax rate. And the dividend allowance is still with us, but it remains at 2,000. That's not been increased. So just one point to note is that for this current tax year and for the previous year, the higher rate threshold and the level at which the high income child benefit charge comes into force were both £50,000. Now, from this April, there's been no increase to the high income child benefit charge threshold. That remains at 50,000. So it's just worth remembering that if you are doing tax planning where you're looking to see how many dividends you can take out to take your income up to the higher rate threshold, then actually that threshold, if you're still receiving child benefit, is still 50,000 for you. That's this extra £270 would, cause you to have a clawback in your child benefit. So that's just something to be mindful of. And then capital gains tax. So the annual exempt amount remains at 12,300. That's not been increased from this April. That's what it currently is. And that has also been frozen until the tax year 2025-26. So there was very little else said in the budget about capital gains tax after there being widespread speculation that there was going to be major changes, and after a recommendation from the Office of Tax Simplification that there should be changes. But nothing was done in the budget. However, as we've already mentioned, one of the major consultation documents that is expected to come out on the 23rd of this month is expected to be on the subject of capital gains tax. So we await that. And similarly, inheritance tax, there's been no changes to the nil rate band. The normal nil rate band is at 325,000 still, and the additional residence nil rate band that you get if you are leaving a main residence to a direct descendant in your will, that remains at 175,000, and both of those rates have been frozen until 2025-26. And again, we suspect that one of the consultations being issued on the 23rd of March may very well cover inheritance tax, because once again, the Office of Tax Simplifications has been looking at this and has produced a report on simplifying inheritance tax. Okay, so if we move to the next slide. So on to national insurance. So for 21-22, there's been a very small increase in the threshold. So there will be no NIC payable on earnings up to £9,570 per annum, and that's an increase of £1 per week. And then the rate remains at 12% on earnings between 9,570 up to 50,270. So the upper limit for the NIC thresholds is now in line with the income tax higher rate threshold and is expected to stay in line. And then of course you've got your extra 1% for earnings above that. And the self-employed will pay 9% class 4 on earnings between 9,570 and 50,270, again with the extra percent for earnings above that. So employers' NIC will only apply to earnings that are over £8,840 per annum. So if you're taking a salary of up to £8,840 in 21-22, that would attract no income tax, no employees' NIC, and no employers' NIC. Okay, and VAT, very simply, the threshold has been frozen for registration at £850,000 turnover, and that's frozen until 2024. So if we move on to the next slide. So the stamp duty land tax holiday, as it's been described. What we're talking about here is the rules in England and Northern Ireland only, because Wales and Scotland do have their own rules. So what happened back in March last year is that this holiday, as it's been described, is actually been an increase in what we call the 0% band for stamp duty. So it was 125,000, that properties worth up to 125,000 attracted 0% stamp duty. So what they did was they increased that 0% rate to 500,000. And this was due to end on the 31st of March this year, but was extended in the budget until the 30th of June. So that is good news for any transactions that are currently still in progress, that they have this extra window to get those transactions finished. Now what's going to happen is this, after the 30th of June, there's going to be a transition effect on bringing the 0% rate back down to what it was at 125,000. So from the 1st of July, the nil rate will drop to 250,000. And then from the 1st of October 21, that's when it will revert to 125,000. And for both of these thresholds, it is eligible for purchases that are completed on or after that date.
So not before.
Sorry?
Not before, isn't it? For the holiday.
For the holiday, yeah.
Yes.
Yeah. But obviously it will revert to 125,000 after the first, any purchase completed on or after the 1st of October 2021. It's important to remember, though, that the 3% surcharge for second and subsequent residences that are being purchased in England and Northern Ireland does continue throughout all of these changes. So you might be buying a house that's worth under 500,000 and would be at a normal 0% stamp duty rate. But if it's your second purchase of a residential property, so that at the end of that day you own 2 residential properties, then the 3% would still apply in that situation. And in addition, the supplementary 2% stamp duty for non-resident buyers who are purchasing residential property in England and Northern Ireland, that is still going to come into force from the 1st of April this year, and will apply across the board, even to your properties that are less than 500,000. Now, the test for whether you're a non-resident buyer is much simpler than the test that exists for other taxes. It is simply, have you spent less than 183 days in the UK in the 12 months preceding the transaction? But yeah, just important to remember that if you are a non-resident buyer, you could also get hit by the 3% as well as this additional 2% if you're buying a second residential property in the UK, in England and Northern Ireland. So I'm going to pass back to Chris just to wrap up with a few final points.
Yeah, if anyone's got any questions, then please feel free. We've got a few coming into the chat box, which we'll deal with at the end. But again, anyone's got anything, just please feel to jump in.
Yeah, thank you very much, Alison. Thank you very much, Stephen. Yes, so a few almost loose end bits that were in the budget. The first one is making tax digital. Now, at the moment, it applies to all VAT registered businesses who are above the compulsory registration threshold of £85,000 turnover. I don't think there are that many VAT registered businesses still that are below the registration threshold, although there are some. Now, but there is a change for those businesses in that they will also have to do making tax digital if they're not already doing it from April 2022. Now, perhaps the bigger change on making tax digital is that we expect there to be an extension to income tax from April 23, and that will include people who are self-employed, not company directors, self-employed individuals trading on their own account, or people who have rental income. They will be within making tax digital, we think, from April 2023. That could cause some fairly significant changes to what people with buy-to-lets need to do. It's also worth noting at that point that the government is intending to change the penalty and late payment regime for income tax over the next couple of years. It's probably a webinar in itself for those who are interested in the detail. It won't be as simple as £100 late filing penalty and 5% after 30 days if you don't pay your tax. It'll be a lot more complicated. The The next bit that the government announced in the budget is that there are various apprenticeship schemes. In other words, paying people to take on younger people in particular as apprentices, as trainees, to try and alleviate some of the youth unemployment that's arising as a consequence of the virus. So the schemes that were announced last summer are being made more generous. The other one I think it's worth touching on is the issue of free ports. The government announced 8 new free ports in England. Now, these are very much driven by Brexit, the idea being to provide somewhere, essentially an expanded, glorified, bonded warehouse where businesses can bring goods in and out of the UK physically, but they don't have to clear them for customs purposes. So, for an example, if you're bringing stuff in from the US and you're bringing it in for both the UK market and the continental market, using a free port, it will now be possible to bring those goods into the port, store them there, and then the goods that are required for the UK market, you clear into the UK, and the goods that are required for the European market will go straight back out without being cleared in the UK and will be first cleared for customs purposes in Rotterdam or whichever other port of entry you're using for the European market. That will help quite a lot of our clients who are struggling with supply chain issues created by Brexit at the moment, and the difficulties of potentially having to manage 2 customs clearances, the risk of getting 2 customs duty charges for the same goods, whether coming in and out of the UK or in and out of Europe. But the free ports go much wider than that, in that the government is also providing other generous tax incentives for businesses to locate to those areas. They're more akin to the old enterprise zone allowance, enterprise zones that existed maybe 10, 20, 30 years ago. They're tax advantaged areas, but they're coming off the back of the customs advantages that the government needs to provide for certain areas to alleviate commercial problems with supply chains. So Liverpool is the location for the Northwest. I don't think it's just an area around the docks. I think there's an area around the airport as well intended to be within it. I think we'll see more as the government's plans develop over the coming months as to the precise locations for the tax advantages. So I think that concludes the budget section itself. I think the next slide is one for Stephen in terms of to plug his next webinar.
Yes, our next webinar. Thank you very much, Chris and Alison. The next webinar is in 2 weeks' time on the 23rd of March, where I'm going to be talking about strategic planning and why it's so important for your business. And if you, in the meantime, want to download the ebook, or if you want a hard copy, we have some hard copies available for you. Just email me and you can get a hard copy of it, but download it. We can talk about how strategic planning is so useful for business now. We're in a period of such uncertainty, potential huge recession as well, that it's vital that you do have a plan. We have a number of clients that have actually gone through this and have seen the benefits already. So that's the next webinar on the 23rd of March. If anyone's got any suggestions of anything that they want to put on, we do have a number already in the pipeline, but if you've got any suggestions of anything you'd like us to talk about, please feel free to drop me a line and we can arrange for those webinars to be put on. What I'd like to do now is just move to a few questions. There's not too many. Mike has asked, a van has cost 20,000 on the 1st of April 21 and sold on the 1st of April for 22 for 15,000. Does the extra 6k extra allowance from 21-22 then be caught, and so on, in reality and balancing charges? Chris, over to you.
Yeah, there are provisions in there so that if you've had a super deduction on the van, when you come to sell it, your proceeds are grossed up to reverse the super deduction. So I think it would be the 15,000 times 1.3 would be the proceeds that would come back into charge to tax.
So effectively, it's get the cash flow advantage now, but potentially pay later. And I think a And me being the ultimate cynic, that's the theme of the budget that we've had so far, is to let's get everyone to make as much profit over the next 2 years, grow your business out of recession, get yourself back to profitability, and then you're going to be hit with 25% tax charge. But that's just the way it's been done.
I think it is. Sorry, Steve, one point that comes on from that about the vans. Yes, there will be proceeds on vans, but for an awful lot of equipment purchases, it's unlikely that you're ever going to be selling it for anything more than a trivial amount. So in that case, you wouldn't need to worry about the reversal and the balancing charge on the reversal.
Okay.
It's going to be vans and similar vans, vehicles and other similar assets that have a resale value where that is a concern.
Okay, Sally's asked, would a shop refit, new office, shop equipment and furniture be included in the 130% deduction against profits?
The answer is most of it probably will be, because it will be classed as plant and equipment. However, there will be elements of it, things like electrical wiring, which are what are known as integral features. And those elements, the super deduction is only 50%. So in practice, you would probably elect out of that and claim the annual investment allowance and get 100% for those instead. Again, we're awaiting the finer details, but I think with your shop refit, most of it will qualify, but probably not all.
Great. And from Orders Ultra, what's the panel's view on how house prices may move over the balance of this year? My own view, I think, is that the fact that we've got a lot of movement going on because of the reduction in the stamp duty, I think it could create a huge demand for properties. So I can't see house prices declining anytime soon. I don't know what your view is, Chris.
I think I would tend to agree with you. There's an awful lot of money floating around at the moment. Our experience is that the world seems to be divided into two camps. Those who've come through the last 12 months and are now sat on cash because they've been earning and been prevented from spending. Those people, I suspect quite a lot of that will end up in the property market, not least without bounce back loans ending up there. And I know of some clients who've done that. Then there are also the other camp is those who have been on furlough, have become unemployed, their businesses have struggled and have got no money, and they're unfortunately unable to partake in the same way. I can't see the government guaranteeing 95% loans being particular help to a lot of those people, but there's probably enough people in the first category that property prices will continue to soar in the way that they have done in the last 12 months. Alison, do you have any thoughts?
I feel like there's a lot of demand out there for people to want to move home, and I think that is an effect of lockdown. And I saw it personally on the street where I live last summer, that people were still putting their houses up for sale and wanting something different because they'd spent so much time in there, they realised it didn't suit their needs anymore. So yeah, I don't think that, I think prices will continue to be buoyant and rise. Yeah.
And I think the government wants it in some ways, both because it avoids some of the problems of falling prices, albeit there are problems of rising prices too, but actually they like people moving house because people tend to move house and then set about doing up the new house, which keeps all the builders happy, and lots of tax revenues flowing in from the construction sector.
Okay, thank you very much. Has anybody else got any questions they want to ask or chip in with their point of view as well before we close?
I've got a couple of questions if possible.
Sure, yeah.
Hi, it's Natalie speaking. Is there any idea or taste of how flexible HMRC are being at the moment with regards to the VAT deferral period? Doesn't appear to be anything new other than start to make arrangements or contact us. Have you had any experience with other clients at how flexible they're being?
For most people, Natalie, the revenues position is that you've got your quarter from last year, which was
that's the one, yeah,
deferred until March. You can now defer that payment and make it over 11 months till next February on a no questions asked basis.
Okay.
So what you need to do is log into the company's government gateway ID account. And then there's a few questions you have to ask. You set up a direct debit and you can pay that quarter's VAT over the period till next February. If you're struggling with it, although it has to be done on the company's own government gateway ID, we have talked to a number of clients through that process.
Okay, so that's helpful, thank you. It was more the fact of, say, industry specific, in particular the hospitality industry, where it's not that we've had reduced revenue, it's just no revenue, if you like, because because of restrictions we've been forced along the line of having venues closed and clients not being able to make bookings. So it's more a taste of above and beyond what they've got in place already at the moment. Is there anything, do you get a feeling from them of how helpful or flexible they are?
They are generous. They are being generous, and it is tied to businesses that are particularly affected. So if you need to go above and beyond there, yes, the expectation would be that debt management would be generous. I'm just going to say, I can't see, but yes, I thought it was you, Natalie. I know which business you're talking about. So yes, because of what you do, the expectation would be that HMRC would be more generous than they would be for someone in a different sector.
Okay, so it's pick the phone up really and talk them through it. Yeah, fabulous. And just the second one, the furlough retention bonus seems to have disappeared. I know it was stopped whilst the furlough was extended. So is there any mention of that in the budget?
It seems to have disappeared.
Yeah.
Yeah.
Okay.
Just one other point as well in relation to your VAT over 11 months. I believe it's interest free as well, so it makes sense to have a go on that. What we're finding some people are doing is they're applying online, and one of the conditions is you have to be up to date with your VAT returns. And unfortunately, the revenue system is seeing a current VAT return as being outstanding and not letting you actually do the 11-month payment plan, because you've got your current period outstanding, even though it might not be due yet. So if you're getting that error message, all you need to do is just phone up, but the revenue are aware of that problem within their system.
Great, thank you.
Anybody else got anything they want to ask? Any other questions? No? Great. Thank you very much indeed for everybody who's joined us this morning. Been a large crowd. A recording of this has appeared on, or will appear on YouTube later on today. If you want to go back and have a look at the slides, just go to YouTube, search for Harts Limited, with limited spelt in full, and you'll be able to get a copy of the recording there as well. We look forward to seeing you on the next webinar in a couple of weeks' time on strategic planning, but just remains for me to say have a great day and a great week. Thank you very much.